As the clock keeps ticking in 2024, economists are making dire predictions about the market in the new year. One economist, Harry Dent, says since 2009 there has been 100% artificial, unprecedented money printing and deficits, $27 trillion over 15 years to be exact. This is off the charts. 100% artificial means we're in a dangerous state. Harry Dent told Fox News Digital, I think 2024 is going to be the biggest single crash year we'll see in our lifetimes. I'm the guy that's praying for a crash while everybody else is not. We need to get back down to normal, and we need to send a message to central banks, he continued. This should be a lesson I don't think we'll ever revisit. I don't think we'll ever see a bubble for any of our lifetimes again. Dent, who spent the majority of his career analyzing proprietary research, credited his against-the-grain prediction to overvalued markets and excessive stimulus spending. While recent rallies have overwhelmingly provided investors with mild recession expectations, Dent remained firm that an everything bubble will burst this year. But Motley Fool says, though fears of a recession persist, a market crash seems unlikely this year. Investors are wrapping up a winning year on the stock market of 2023. The S&P 500 was up 18%, well ahead of the 10% average price gain for the broad market index. That increase has come despite interest rate hikes from the Federal Reserve, persistent inflation, and geopolitical tensions showing how unpredictable the stock market can be. Looking ahead this year, it's only natural to ask what is in store for the stock market in 2024. That's especially true as investors still face many of the same macroeconomic concerns that has hovered over their heads since the COVID pandemic. Interest rates remain elevated, which has squeezed the housing market, business investment, and consumer spending. Fed Chair Jerome Powell has signaled that they will remain elevated until inflation approaches 2%, and some economists are still forecasting a recession this year. There are also signs that consumer spending is weakening, partly due to the restart of student loan payments. Most economists, businesses, and the Federal Reserve seem to believe that 2024 will mark the nadir in the current economic cycle. However, a stock market crash this year, which is not a well-defined term but could mean a slide of 20% or more, seems unlikely for the following three reasons. Interest rates are expected to start coming down. Interest rates and stock prices tend to have an inverse relationship. When interest rates rise, stock prices generally fall and vice versa. That's because investors tend to move money out of the stock market and into the bond market when interest rates are up, and rising interest rates act as a brake on the economy. Falling interest rates therefore beckon money back into the stock market as bond yields fall, and lower rates provide a tailwind to economic growth by making it easier to borrow money. The recent market rally is due to the investors' belief the Fed won't raise rates anymore as inflation is falling and the economy is softening. The central bank forecasted in its September of 2023 dot plot that the Fed's funds rate would fall by 50 basis points next year. That was higher than the previous forecast, indicating the central bank expected rates to stay higher for longer. Overall, a soft landing, inflation normalizing without a recession seems increasingly likely. Growth at big tech companies is accelerating. The recession in the tech sector has already come and gone. Big tech companies like Amazon, Alphabet, Microsoft, and Meta Platforms all announced layoffs roughly a year ago and have seen sales and profit growth mostly accelerate over the last year. The tech industries was challenged by the end of the pandemic, but they've right-sized their costs and enjoyed a boom from new artificial intelligence technologies, which could take another step forward in 2024. How this handful of tech stocks perform is important because they make up a sizable portion of the S&P 500 and have outsized influence over how the major indexes move. If they remain healthy and continue to deliver solid growth, it will be difficult for the stock market to crash. The economy still looks solid. While much uncertainty remains, the baseline economic data is encouraging. The unemployment rate is still under 4%, and it's been that low for 16 months, one of the longest stretches of low unemployment in U.S. history. Meanwhile, gross domestic product grew at an annualized rate of 4.9% in the third quarter of 2023, showing that overall economic growth remains robust despite elevated interest rates and other concerns. While some sectors like real estate are currently struggling, the overall economy still seems to be on a solid footing, making an economic crash unlikely for 2024. That, in turn, means the stock market probably won't experience a sharp pullback either. In conclusion, volatility is the price of admission. Smart investors know the stock market will almost certainly help you generate wealth over the long term, but it's much more unpredictable in the short term. While there's some visibility into what the economy will look like in 2024, plenty of things could still change that, including expanding global conflicts, a political crisis, or a black swan event like the pandemic. Stock market investors need to accept some uncertainty in exchange for getting results above the risk-free rate over the long term. There's still plenty of risk heading into 2024, but given the current trajectory and the economic facts on the ground, a stock market crash is unlikely. It's certainly no reason to avoid investing in stocks this year.